Hello, hello, hello. We are live. This is AddieNet with MLO. I'm going to give myself my own little round of applause today. Exciting stuff. We've got a pretty big topic today. So, credit. It's actually one of those pretty important things in the financing world. So, I have to put a few layers on today's topic. We are not licensed credit repair experts, anything, but today we want to share our experiences with credit, how they affect your mortgage, and what you can do to maybe prepare. So I'm going to bring in the team here. First and foremost, we got CK in the house. CK. Thank you for making it.
Thank you.
And let's see, Casey Carpenter's actually checking into the classroom. Boom.
There he is.
Carp in the house.
We got everyone in.
Thanks for not keeping me out in the hallway.
We got it all. We got the head mods going. I kind of thought I would bring in the theme music early with your introductions. How was it?
I like it.
Felt like an
Very
NBA lineup.
smooth. Very smooth.
It's super fun. So, guys, and I don't know if you heard, well, before I brought you in, I did layer like, hey, we're going to have to preface compliantly big time because we're talking about credit. This is a big role. It's a huge role in our country and our economy. It's a big deal in all financing, from your auto loans to your credit cards to your student loans to your mortgage payment. And today we really want to share some stories with credit and things that we've seen and experienced that can hopefully kind of funnel together some advisements from a non-official way. And I have to say that because technically, I hear a little. Who's got the kids in the background?
Hey, that's definitely me. Definitely the kids. Thought I had it on silent.
Welcome to the remote live streaming, but it makes it real. So we just have to put that out there for all of our listeners that, you know, we're not licensed credit specialists, but we certainly look at hundreds of credit reports on a quarterly basis. I've got my own credit story that we can dive into. Christian as well has been around the block a few times or a few decades. Casey's shy, but we're going to try to crack open that candidate from it.
So the credit.
I think one of the main things to start with, guys, and this will be really general, is how accurate are you seeing Credit Karma to actual hard pulls? And maybe even backing that up, Christian, would you mind informing everyone the difference between a credit estimator and then a hard pull within a mortgage application?
Yeah, definitely. So many of you guys probably use a credit tool, maybe through your bank or your credit card. Those are doing soft pulls. A hard pull would be if you were to go buy a car or apply for a mortgage. Typically, and I'm not gonna say typically, well, I guess I gotta say typically because we're talking in broad strokes here. A mortgage pull for is going to count for the next 90 days. So if you are shopping your rate around with lenders, they're going to count that as one hard pull. So yeah, you don't want to be going to 10 different ones, but when we've sat down with some of our credit agencies, they're telling me that's going to be one pull for that first 60 days. Excuse me, not 90 days, but 60 days. So think about that. Supposedly they do that with, when you're shopping for cars as well. But I know that when I've gone out there and I've gone to a couple different dealerships, there have been multiple hard pulls on my credit. So keep that in mind out there. So the difference in between the two is hard pull is you're requesting credit. A soft pull, you're requesting to see what your credit score is and that your balances are matching up to what you believe they are.
Yeah, and I would add in like a couple things that have changed over the last few years. The Fair Credit Reporting Act has opened up some great acts that protect the borrower. So it used to be you didn't want to pull your mortgage score from multiple lenders. And now there's actually timelines that protect the applicants. So they are able to go out there and shop terms, shop personalities, and people that are looking to help them. So that's something that's really good to know. And if you ever hear a lender say, like, don't go pull your credit with another lender because it screws up your score, that's totally not true.
That's right.
So typically, I believe it's 30 days you're protected in a window to go to multiple banks and run your credit. One of the biggest things I'm seeing, and I want to address this, is like, what's the difference between Credit Karma and a mortgage pull? So like for me, the easiest way I explain it to my clients and anyone that I work with is, look, Credit Karma is an estimator. It's going to estimate balances mostly on public data that an individual bureau is going to disclose, versus the mortgage pull. It is a hard pull. That's the term. So it takes from all three credit bureaus. So all of you that are out there and wondering, there are three bureaus: TransUnion, Experian, and Equifax. So there are all three. And I always say, hey, mortgage pulls is the credit Olympics. Like, they pull from all three of the bureaus, and the score that's used associated with your file is the middle of the three. So if you've got a 700, a 650, and a 680, the middle in this scenario, 680, would be your qualifying score. And we're going to dive into why that's important, but remember the qualifying score, and it pulls from all three and takes the middle. Now with like an auto loan, Casey, like you've bought cars, I know that when you go to a dealership, they might run credit completely different. That dealership might only pull from one bureau, or they might use a different Vantage Point scoring system or FICO. So you might go to Ron Tonkin or something and think that you have a 770, and then you do a hard pull, and the lender you're working with is says you have a 730. So that is really confusing to some clients, I've learned over the years. And it's important to know that, you know, you've got the credit Olympics, mortgage, hard pull, you've got auto loans, and then now even credit cards, depending on the company, will use one bureau or their own scoring system. Right. And then everyone in the world that has an app, when it regards to financing, gives free credit updates. So there's a lot of confusing information. Casey, are you experiencing like anyone saying that, where it's like, oh, you know, Jimmy Bobbitt used Honda Civics that I had an 800, and then, you know, we're looking at a slightly different situation on a mortgage pull?
Yeah, absolutely. I mean, I would say 75% of the time with clients. And it's just the way you explained it. I mean, you have different pulls: hard pulls, soft pulls, but you also have those credit cards that are giving you FICO scores, or you got the Credit Karma, but it's only, again, it could be one of those three agencies. So, you know, it's just, I see it never come across really accurate on what they're, you know, reflecting from those Credit Karmas and stuff like that. It might be close. What I tell clients is it gives you a good observation maybe of where your credit is at, but take that in a broad spectrum, because they're just different than when we pull them on a hard pull and see them from all three agencies.
Right.
Yeah. No, that's a really good point. And
hey, Addison, what are you, I mean, for the clients out there, or people listening, or young people out there, can you maybe touch on what are the ranges in credit scores and what those three identifying numbers really mean for them?
Yeah, I'd say, like, when I always talk about credit, I think I want to start with what I've learned, because before I got married, I made an unfortunate relationship choice, which demolished my credit from hero to zero super quick. Well, I guess I could bore you with the story. Essentially, like,
please do.
Yeah, I broke up with this gal, and I tried to do the right thing, you know, where I was like, hey, you take our life financially, like where we lived, the car, everything, and I'll start my new, you know, journey and whatnot. And everything was primarily under both of our names. This individual decided to jet off to Australia to take a job, and left everything to foreclose and default, and I had zero access. I had essentially tried to start a new life, not attached to that. And you know, I went from a mid 700 score into, and I had to clear my throat, lower 500. So this is like before I was even in the game of mortgages and financing and helping people. And I had to learn kind of by myself how to rebuild it. And I went through, like, you know, we've all seen the credit repair ads, and we're going to pull you out of the gutter. And I'm not the biggest fan of those. A lot of those you can do on your own. and you understand at least the framework of how credit works. And I like to use the analogy of like it's a pie. So your credit score is like one big pie, and there's all these slices of the pie, and within those pie slices, you have an opportunity every month to get the maximum of points for your score. So a couple things that I experienced and learned going through credit repair counseling, going through building up my own credit back into the high 700s was one of these credit counselors are going to teach you this right off the bat. And you're going to pay like $150 to $200 to have this story told to you. So in the credit pie, the biggest driver is revolving debt and credit history. So the length of time you've had revolving debt, which is credit cards. And the key component that they taught me this was you need a minimum of 3 trade lines, which is another word for accounts, essentially.
Right.
So that you get a lot of people who just have 1 or just have 2. But I've been coached and heard from multiple credit agencies that 3 is the magic number. So a lot of people who don't have much credit, they're like, well, how am I going to get 3 cards, right? So typically what you'll start with is secured credit cards, which means that that's a requirement of a deposit. So I always advise getting a secured card every paycheck if you can. And depending on the institution that's extending you the credit, the deposit's going to range. I've seen anywhere from $100 to $200. But the kicker is to get into a graduatable card right off the start. Right. Because there's a lot of companies that say they're here to help you build your credit, and that card is never graduatable, which I don't want to confuse anyone, but you go from secured with a deposit to unsecured. So the graduation would be getting your deposit back upon X amount of on-time payments. And then it goes from not having that deposit to a full unsecured line of credit. And that's how you're winning. So if you can get 3 of those, that really is the base point start. And, hit us up directly if you want a little more suggestions on specific companies, not on live streaming. I don't want to endorse or unendorse certain companies, but look out for that graduatable thing. So going back to you, Christian, your original question, how can younger people start establishing credit? I don't think it's ever too early to get a secured credit card, because even if you say, don't have any sort of credit score, if you've got a couple $100, which is a very standard deposit amount, you can get that going and you can start, building credit and use it and pay it off. Another thing I've heard from a lot of advisors when it comes to the credit is the ideal balance. So credit utilization is the next step. Once you've evolved a credit history, utilization is the huge factor. And that is all factored by how much you owe and what your limit is. So what I've been told from advisors in the credit world is 1 to 19% is the ideal credit utilization ratio. So say you've got $100 limit, you want your balances, what I've been told, to be between $1 and $19 a month max. So then it tier levels. If you go up to 50% utilization to 75 to 90 or maxed out, the score just continues to drop. So the utilization part is where we see a lot of surprises when people get their credit pulled with us. They're like, whoa, I didn't know that it went to 660 or something. And you're like, oh, well, it looks like all of your cards are over 50% utilization. So that's where you're going to see a huge swing in the credit. And I know I'm going on a run here. I would say lastly, building history early allows you to grow out your credit limits, which then reduces any sort of major shifts regardless of what you're charging. So to explain that a little more clarity, say you start at $100 limit and you have history with this company, you get your credit line increased all the way up to $10,000. You could put $1,000 charge on your card and only utilize 10%. Versus if you only had $100 limit, $10 is 10%. That's nothing. It's a trip to the grocery store, or the mini mart. So starting off early is right off the bat. Student loans seem to really help too. A longevity of paying off the student loan, not deferred, but paying them helps. Yeah, Casey, have you? I mean, is there anything to add to what I just spun off there? I feel like I'm just rambling, and this is like,
well, I kind of want to reiterate that fact that you're touching on, just for all the listeners out there. I mean, you'd be surprised that, people at all stages of their life and all ages might not have credit yet. And so I think, when you're sitting there getting ready to purchase something, I mean, this credit score is a big determining factor of financing nowadays. So try not to wait till you're ready to purchase something and then go, oh, I don't have, a credit score. I need to work on that, because that's obviously going to delay that. What Addison mentioned was, try to start that early. Start that with that secured card or graduate to the unsecured card. But if you're starting to build that credit and your credit history early, when you come in later on and you need finance and you have that established already. I got friends in their early 30s that just don't have credit established yet,
Casey, I totally respect the fact that some people are like, I hate credit cards. I hate
totally.
this. And like,
totally.
Oh yeah, 100%. Me too. But like,
I hate car payments. Hate them.
It's like, this is the game, and these are some of the rules. It's like, I hate the fact that there's out of bounds in golf, but like, it is what it is. And this country is like completely formed around your access to finance and lending from a business and personal standpoint. And we'll dive into a little deeper. Your score does dramatically affect the terms that you're going to get, for the most part, on a mortgage specifically, and even cars, to the point, like you could have somebody say that's got a 800 credit score versus 600. Like that 800 credit score might be able to have the same payment on a $50,000 luxury car as the 600 credit score driving a really beat up piece of crap car just because of the rate and the terms associated with the credit score. So it really does impact how this country works and the lifestyle. So it's one of those things. I mean, starting early. Another one, Kempers was talking about this too, was utilizing family members for establishing credit. And this is something that becomes a little more technical, and we highly recommend like work with your credit counselor, touch base with your loan officer on your strategy, but adding yourself to a family member's trade line as an authorized user can help accelerate your credit score, because the minute you are added on as an authorized user, you do inherit the entire history,
the longevity
of that trade line. So that's a double-edged sword too, Christian. Like we ran into this before. Yes. Like, okay, you don't want to add on to someone who's got 14 missed payments. Like
that's right.
You don't want the baggage. We want the cream of the crop. So pick like, I remember when I was going through the rebuilding, like my in-laws threw me on their 17-year Unitas Air Miles card. Right. That had like, a 15 solid history, never missed. And like, I had this huge jump, just because I went from, rags to a fighting chance in the FICO world. They just as an algorithm. So, I love that CK brought that up and different ways to do it, but those are technical moves, and it's not one to be like, oh, I heard this. Like, get with people that understand your report, licensed credit advisors. One thing I think a lot of people don't know, and this is why I encourage individuals to connect with their loan officer early, because this is a common thing. I'm not ready for another year to buy. It's like, well, you should have a clear understanding where your credit's at, because if there's things that we could do over the next 6 to 12 months to increase it, and sometimes it's as little as like work on getting an increase of your line of credit or get a third card because you only have two, it is a huge difference in how the terms of your mortgage are created. So we wanted to develop a plan and work with you. And loan officers will, on the back end, typically have a credit servicing company whom you guys proactively as a team can work with and utilize some scenario estimators. So there's tools that we could use at zero cost to the client and say, oh, well, what if, right? The what if scenario, but if I, pay down this debt or I close this account, and it will simulate to the best of its ability where your score will land. And I don't think I've ever heard any loan officer talk about that. Have you, CK?
I haven't, and I know that you and I use that day in, day out, especially when we got a client right on the edge of like a 719, trying to get them to the 720 to give them a solid pricing adjustment for their favor. Um, the whole thing about credit from a start, when you start getting it or applying for it, it could cost you thousands, hundreds of thousands of dollars on a mortgage. Just the difference from having a 760 credit score versus a 660. That 100-point difference is so crucial. And then what programs you go into as well. So being aware of where your credit score is and how to improve it, going in with a strategy with the advisor is going to just save you so much money down the road. And the sooner you can learn those tools, the better you're going to be when you're buying cars, saving on 0% interest credit cards, transfer balances. There's so many other things that you can use that to your advantage and use credit as a tool.
Yeah, no, that's a good point. I think, to try to give some framework to the clients, how does your credit score determine your rate? And right. I think there's some misperceptions out there. I've gotten some feedback where, say the credit score might not be as great, but someone is a high income earner and has a significant amount of cash flow. To the consumer, it's confusing to them. Well, and to me, it takes the wind out of my sails when people are like, but, and they think I'm making a decision on what the rate is because of their credit score. It's like, well, I make a ton of money. That shouldn't matter. I was like, well, it does matter, because what happens is there are investors who buy these loans, and that's how it's determined on a value. The investor determines the interest rate associated with the risk. The risk is determined by the credit score. That is a primary driver to how rates are determined. So just to give an example, for most lending institutions, and it's different, the minimum credit score is 620 for a conventional conforming loan. Now, using that example for most lenders being 620 on the mid score, the rate will change typically every 20 points, most of the time. So say 620 is the lowest tier, meaning the worst interest rate allowable. And then once you get to 640, 660, 680, 720, 740, and 760 and beyond, most cap out at like a 740 to 780 top of the line, depending on the lender. So your interest rate will get better as those goes up. So say we have a credit card that's overutilized because it's a tiny limit. It might be like a $500 Best Buy card, and you bought, let's use $1,000 Best Buy card, and you bought a $999 TV and put it on the Best Buy card because Best Buy offered you like free earbuds or whatever if you do this today. And you're like, heck yeah, I've always wanted those. Those are sweet. And you do it, you've now maxed out a trade line. You've, in that situation, over 99% utilization. So unless you attack that balance prior to the end of the account statement, your credit score will be affected significantly. And then all because you wanted free earbuds, your interest rate on your mortgage went up 0.75 just to make up a number, which affected your mortgage payment by, just to make up another number, $200 a month. We're like for life, for 30 years. Like if you on the entire
the earbuds,
all for we'll blame it on the earbuds, Casey. Like it's the free this, nothing's ever free. But I think those are really good examples, and that's a good breakdown of how interest rates, typically and generally speaking, are determined. Now there are other adjusters like say down payment,
loan to value, yes,
like anything. There are other adjusters, but I'm just trying to speak specifically to the credit score and how it's associated.
Yeah.
Another determining factor, Christian and Casey, I'm
Mhm.
sure you've run into this too, and I'm going to cite it to Christian, two people on a loan.
Yeah.
How do we determine who scored you?
Yeah. So if we got two borrowers on the loan, we cannot go with the highest middle score. We have to use the lowest middle score in order to qualify the home loan. So if we, for example, Addison, if we have a borrower with a 760, 780, and a 750, and a borrower with a 625, a 640, and a 680, we have to go with that 640 score. So we might look at some different options, but you got to think about that when you're applying with your significant other or that co-borrower, how that will affect the total holistic of the interest rate on that new home loan. So unfortunately, we do have to go with that lowest score, but it's a main part of the mortgage loan is all parts and who are at risk on the loan. So that's why we do that.
Yeah, no, you're only as strong as your weakest link. That's
Right.
the line that I use, and
Mhm.
but it's a big factor because a lot of the times, say, we need a co-applicant, whether it's a spouse or even a
Mhm.
parent, which is super common.
Mhm.
Their debt and their credit score will be a factor in. So yeah, you might have a cosigner like Billy Bob, who's been sleeping on the couch, is willing to cosign, but if he's got a 440 credit score, you're absolutely done. Like
Yeah.
that doesn't help. So I think that's a really common question. Another one to put together. One of the last points I want to make is length of history is really important factor as well. So a lot of the things I've learned is that credit is also valued, going back to the sliver of the pie of how long you've had a good attendance record of on-time payments. And I think one of the biggest things I see is people will make an aggressive plan. Like they've been binge watching like Ramsey or whoever that financial guy is, and they're like all hot to trot regarding paying down their debt. That's fantastic. One mistake I see a lot is someone will pay off their debt and close out the account. And what they don't know is when you close that out, like great work paying it off, but when you close it out, it's like a whiteboard. You've now erased all your on-time attendance, on-time payment records, and you lost all your credit badges of success. So people, I've seen scores drop significantly not knowing that. So I try to always remind people.
Yeah, Addison, and I
It's
think
better
you're
to have a
talking
little bit of
to
debt.
yeah, I think we're talking more towards revolving credit versus installment credit too. Maybe kind of tell the difference between the two of those.
I mean, I've seen it on both ends. Like,
Yeah, didn't fulfill
revolving
the total installment plan, so you've seen it go down.
100%.
Gotcha.
Most often with
Revolving.
auto loans. So like someone might pay off their car and then that 5 years of on-time payment just disappeared, and that was a heavily weighted factor in their credit score, and because it got paid off, which was a huge goal, it went down. The confusing part though, and you can't find it or Google it, and like it's this whole confusing thing, is there are some theories out there is like, oh, if you complete every single payment, that's fine. But if you pay it off early, I've seen the drop off. So it's weird. Like I've seen them both ways, and there's really no determining. I've just holistically noticed that when you close out accounts, unless you've got supplementing history on your credit
Gotcha.
report,
Yeah.
meaning like other supporting trade lines, you could see a massive fall off. Like if you just have one auto loan and one credit card, and you close out that credit card, you have 0 points in the credit card sliced pie. And maybe you just closed out your auto loan, which was your only installment loan on your credit history. So I think, what makes it tough for like Casey, Christian, and I is we want to be as accurate as possible. Like I love our job because typically we're in the black and white. there's like a guideline, a yes or a no, or an underwriter to reach out to. Credit is one of the freaking gray areas. Like for the most part, we know from experience, but they also teach all these loan officers never to advise on credit, which is why we're layering this entire conversation with so much like compliance jargon about like, sorry, we're not licensed or this and that, and this is our story. But it's so important. And like, I think going back to just utilizing those tools as a team, your loan officer and yourself, and the credit servicing what ifs to get a best, strategy based on some of these simulators that are out there.
And I mean, we see it every day. I mean, this is every day we see credit reports. We go through them. We're looking at them, and we're trying to, educate all of our listeners here. We're just trying to give useful information. Obviously, we're trying to keep it broad. Stuff does change. You always want to come back to your lender. There's different stuff out there. I have seen in a certain couple situations where, as we were talking about, two different credit scores with borrowers, right? One being maybe lower, the other being higher, in cases where you had a really high wage earner, that had the good credit score. And sometimes, you might see a lender, use that because they're the high wage earner. So we try to be broad with it. There's going to be credits. It's so gray. Everyone might look at it different. Lenders, might have different rules or opinions on how they're going to do stuff on it. So it's very important to get with your lender and loan officer and talk about that stuff. Have them walk through the credit report with you. Have them show you, if they can, in person walking through stuff or whatever it is, so you can be educated as a consumer on where your credit is at. Because honestly, guys, how many people out there have really sat there and looked at their credit report?
Yeah, no, yeah. It's a really good
point. That's even us, it's not like we're sitting here seeing our credit reports all the time either.
Right. So I think that's part of our job too, is to scrub that with the client and go over each trade line to make sure that that is theirs. Because sometimes we find some things that are like, I don't know who that is. Well, they might be a junior or something that was attached to them from their father or their son.
Or an identity theft situation.
Identity theft is huge. We're watching this, and that's why most people are monitoring their credit right now, and it's great. It's the best thing it's ever happened to us as loan officers, because people actually know what's on their credit report typically. So we're seeing a big adjustment in the learning curve of what is going on with our clients, because they're aware. I could tell you 10, 15 years ago when I started in the industry, a little bit longer than that, but people weren't aware of where their credit scores were, what was on their credit. Everybody's much more educated, and I'm just happy that everybody's out there taking advantage of the high, scores to get them the lowest interest rate on all levels. And right now is the best time. We've been at home and we've been trying to get a strategy on our budgets, and credit's going to be one of those things that everybody's is going to be looking at.
Yeah, that's a great point, CK. I want to just do one little tidbit of inside information from my own experience, especially for the veterans out there, and especially if you're active duty. I know my first year in service, I got deployed as soon as I got to my ship, so I never even saw, a home port station of San Diego. So day I got there, we sent out for a deployment. They can be 6 months to 9 months. Obviously, it's 2007, so we're going to the Middle East. I called my cellular service company and let them know I was going on deployment. It was a 6 to 9 month probably range. Could you please, shut off my cell phone bill? And it's just a big, important piece, because what happened is I got back, it never got shut off. I didn't have the information for the person I gave it to, so no one could prove that I actually had it shut off, and my cell phone payment went unpaid for 9 months, and I got stuck in collections. And I had my credit score tanked. I had, $2,500 collection bill just dragging on. I scraped myself out and made it through. But the lesson I learned is, especially as active duty military, and you're going out on tour, getting deployed, make sure you're getting the information for all your active credit lines that maybe can be, delayed or paused while you're on tour. All the information from the people you're talking to. So when you come back, you have that exact information when you called them, and can prove that, that can get shut off. Because that's the last thing you want, is you're defending the country, come back and be in collections.
Yeah. Great point.
Yeah, no.
Collections.
Yeah, and I know like that's probably the big one too. I think a lot of people think that taking like once it hit what I've noticed, personal opinion, once it's hit a collection status, the damage is really done. I
Right.
haven't seen a whole lot of impact on like say it's like a small utility bill. Like once it goes to collections, it's a ink stain on a white dress shirt. It's just like not coming out. I don't care how much oxy free soaking you do.
It's
And
there. And
it's
truth be
there.
told, on mine, I did try to fight a little bit, but at the end of the day, I ended up just having to play that out, clear it out, and start from scratch and build it up from there.
It's not the end all too. Like there's X amount of years that it eventually and legally needs to fall off. And I've seen a lot of changes in the way credit reports will impact the score on collections. And they're putting I've noticed a heavy weight of how old the collection is. So the older it gets, the less impact it's having on your score. That's my personal observation looking at hundreds of credit scores. I always say, because people are like, well, I'm going to pay off all my collections and then I'm going to apply for a mortgage. First of all, you might or might not, depending on the loan program and the underwriting system, you might or might not have to address them. So like for me, I always say, hey, let's get you through underwriting and see what an underwriting system requires us to do, what an underwriter makes us do, because I'd rather see people have their money in their account whom have are aggressively saving for a home loan than like blindly throw it at some sort of mobile bill that got lost in translation. That few $100s might be precious dollars toward an inspection or almost to a down payment for some people. So I always say wait for advisement of underwriting, because you might not have to pay it off.
Yeah, really good point.
Yeah, that's a good point.
Well, especially toward medical. I've seen a lot more flexibility medical related collections. I will try not to get political, but unfortunately the medical world, like it makes it tough in the United States. So I think
medical and cell phones. I see it. You see them all the time.
Oh, and lastly, I would say one of the biggest changes I've seen. So do you guys remember, I think it was like 6 to 12 months ago, Experian was doing all those ads to like boost your score. So I was seeing all those all the time. And then all of a sudden on all my applications, like every once in a while I was seeing people's credit report show their utility bill and their cell phone bill self-reported.
Yep.
And I was like, oh my gosh. And I finally teed it together with one of the underwriters I was working with. That's what that is. They tell you to self-report things that don't show up, like your mobile bill or your gas or water, electric bill, and they start showing up there.
Alternative credit, yeah.
Alternative credit. So I have seen some successes, not necessarily to the dramatic ones that we've seen on the commercials where the corny guy's like, my score went up 140 points. Like, I'm not sure if they had that corny of a voice, but that's what that's what came out of it.
I think they're calling you for their next commercial ad.
My score went up 75 points because I
got the boost.
Not gonna boost it that hard. Let's get real. It could help a little bit, especially when you're just starting, but it's not going to be like this huge boomerang.
And I mean, full disclosure, I've seen it where clients have worked with companies and stuff like that, and they've come back and, whatever that time frame was, short time frame, maybe a month, couple months, come back with a dramatic, improvement in their score. I have also seen the opposite happen as well.
You've seen it go the other way?
Unfortunately, I've seen some clients, work with a credit repair agency and it go the opposite way. I'm sure maybe that needed to be a long-term growth. Who knows about the history and stuff like that? Maybe, it dropped, but from the experience, at least I've seen it both sides from clients anyway, telling me.
Sure. Yeah, I think if you get with a real mortgage advisor that does look at credit reports day in, day out, they could advise you and use some of the tools that we do have to achieve the same goals that those companies prepare for you. So get with your mortgage advisor and we can get a head start before you make that big financial decision. so that we can get you in the high sevens to take advantage of the best rates that we can get for you.
Yeah, and it might be a road, like, to kind of conclude my story, that like 540 to 620 took about 90 days. So I saw a big bump just doing the execution. This was a long time ago, so it might be quicker, or a long time ago for me, like 7 years ago. It might be quicker or slower now. It's a evolving analysis, but that 540 to 620, you can execute that in 3 to 6 months for sure. That 620 to 680, I noticed, is more of a 6 to 12 month roadmap. And then if anyone's sitting, in that 600 range, I see it the most. It's typically just credit utilization ratio for someone in that mid 600s most of the time, not always, but like guaranteed. Well, I can't say guaranteed, but high probability. If you reduce that down to that 1 to 19% utilization, you have a really strong chance of being in the low to mid 700s. I'm smiling because I keep catching myself saying things like guarantee or
Guarantee.
you will. I'm not allowed to say any of that. So I'm trying to be like, it's in it. Like, what are alternative phrases I could use?
Possibly.
It's possible. I encourage. I've seen. So yeah, the 2-year plan to get in the mid 700s is super possible. Yeah. I typically see someone who's never bought a home to kind of be capped out at a 730 at the very highest. It feels like most of the time you need to at least have mortgage history to be higher than that, or supplementing history, such as like a 10-year student loan account, or you've had 2 auto loans, perfect, like $20,000 limits on all your credit cards. But if you just kind of have a standard history, it's tough to kind of get over some of the stages, I've noticed, if you haven't diversified your credit history with something like a mortgage. So it's in your best interest, no pun intended, to go that route as well. So, oh my gosh, I think it'll definitely be another episode eventually.
Yeah.
It's such a broad topic. It's such a great topic. We're here for all the questions. If any listeners listened, to some of the key points we talked about, and it was your scenario, shoot us a question.
That's what I like, that promo vid that they made for us.
Shoot it.
With Christian. What was Christian? He said, like, send us a topic.
Send me the topic.
Send us
jump
the topic.
on it.
We'll get it on the list. Well, I think that's a good way to round. I know a lot of people wanted to hear that topic and talk about it, and a lot of people are scared. Like, hopefully we layer ourselves with enough compliance. Nobody's going to be knocking on our door. But once again, we're just trying to build an environment of transparency for home buyers and home sellers, industry partners. These are topics and things people want to hear about, and they directly impact everybody's lives. So thank you for listening to this episode of MLO. Of course, Casey Carpenter, thanks for joining us today.
Thanks, Addie. Appreciate it.
Get an applause. Kempers, I'm going to give you magical sprinkle sound effects. Thank you.
I like it. Thank you.
Thanks for being
a great weekend, you guys. We'll see you on Wednesday.
Thanks a lot.
Happy Friday.